Hi students, welcome to our video class. I am Rajanish. Today we are going to solve a problem related with a revaluation account. In our last video, we discussed the important journal entries for a revaluation. That's are when asset increases, when asset decreases, or when liability increases or decreases, and unrecorded assets and unrecorded liabilities. Also, the journal entry related with the net profit or net loss of a revaluation account. Now, we can solve a problem. X and Y are partners in a firm sharing profit and loss in the ratio of 3:2. Their balance sheet as on 31st March 2013 as given. Here, some assets, liabilities and partners' capitals are given in this balance sheet and also given some additional information. We need to pass the journal entries and prepare a revaluation account. On 1st April 2013, Z is admitted for 1/5 share on the following terms. Here in this question, Z, a new partner, is admitted. The old partners are X and Y, and they admitted a new partner Z. At the time of admission of a new partner, you should remember some points. New ratio, sacrificing ratio, old ratio, and treatment of goodwill. Okay, here first point is Z will bring rupees 20,000 as capital and rupees 5,000 as goodwill. Here the new partner brings capital and goodwill. The journal entry for this transaction we know. So I will not explain deeply. First, we need to check in balance sheet. Is there any goodwill is appeared? If it is appearing, first we need to write off. But here no goodwill is appear in the balance sheet. Then we can make journal entry. Cash account debtor rupees 25,000, to capital rupees 20,000, to premium for goodwill rupees 5,000. And this premium we need to distribute to sacrificing partners in sacrificing ratio. So journal entry is premium for goodwill account debtor rupees 5,000, to X capital account rupees 3,000, to Y's capital account rupees 2,000. Now we can go for a revaluation. The second point, machinery valued at rupees 20,000 and building valued at rupees 60,000. If any amount given after the word at is the market value, here in the balance sheet the value of machinery is rupees 30,000. But now the market value is rupees 20,000 only. Here the book value of machinery is rupees 30,000 and the market value is only 20,000. So the machinery values decreased rupees 10,000, right? When asset is decreased, we should credit the asset, and when the loss is arised, that time we will debit the revaluation account. Okay, the amount, how much is the difference, that only we can record in the books of accounts. Here only 10,000 is decreased. So 10,000 is the loss amount. This 10,000 only we can record in the books. So the journal entry is revaluation account at rupees 10,000 to machinery account rupees 10,000. Then the building value at rupees 60,000. Here also at means market value. The market value is 60,000. And what is the book value? This is 40,000. So market value is 60,000 and the book value is 40,000. That means 20,000 is increased. So asset value is increased. That means we have the profit. And what is the journal entry? Building account debtor 20,000 to revaluation account 20,000. The difference amount 60,000 minus book value 40,000, the 20,000 we have to record in the books. When the asset value is increased, we have to debit the asset, and same time the profit also increased. Revaluation account is a nominal account. So the rule, credit all incomes and gain. So revaluation account we have to credit. Okay. The next point is furniture is depreciated by 2000 and stock appreciated by 3000. If any amount is given after the word by, that is the profit or loss. Here furniture is depreciated by 2000. That means the actual furniture value is 20,000 and it is depreciated by 2000, means the 2000 is decreased. That means furniture amount is decreased. So when asset is decreased, we have got loss. When asset value is decreased, we will credit the asset, and when the loss is arised, the revaluation account will debit. So the journal entry is revaluation account debtor 2000 to furniture account 2000. Only the profit or loss we have to record. Here 2000 is the loss amount, depreciated amount. Next, stock is appreciated by 3000. Here also the word by. After the word by, the amount is the profit or loss. Here stock is appreciated. Appreciated means increased. Increased means we have profit. Actual book value is 13,000 and now the new value of stock is increased by 3000. So the book value is 13,000 plus profit 3000. The stock value is 16,000. So 3000 is the profit. So what we will do? We will debit the stock, debit the asset and credit the revaluation. So the journal entry is stock account debtor 3000 to revaluation account 3000. The next term, a provision of 10% is provided on debtors. Here, a provision is a loss or expenses that will definitely occur in the future, but we don't know exactly how much or when the loss will occur. It is considered as a liability, right? Here, a provision of 10% is provided on debtors. Debtors amount is 5,000 and 10% of debtors we will treat as a provision. Okay, so provision is a liability. The liabilities increases. So what will happen? When liability increases, the loss will increase. Here, debtors amount is 5,000 and 10% on debtors, that is 500, is the liability. It is the loss. So what we have to do? When liability increases, we have to credit, and when loss increases, we have to debit the revaluation account. The journal entry is revaluation account debtor 500 to provision for doubtful debts rupees 500. Next term, creditors amount to rupees 1500 are not likely to arise, therefore written off. In our balance sheet, in liability side, creditors is rupees 30,000. Out of 30,000, 1500 amount are not likely to arise. So we need to written off. Written off means the creditors is reducing, creditors is decreasing. When liability is decreasing, we need to debit that liability. When profit is increasing, the nominal account, the revaluation account, we have to credit. So the journal entry is creditors account debtor 1500 to revaluation account 1500. The next point, there is an unrecorded liability for outstanding salary rupees 4,000. Here, an outstanding salary is there 4,000, but it is not yet recorded. So we need to record this outstanding salary into the books of account 4,000 rupees. So what will happen? When the liability is increasing, the loss also increasing. When liability is increasing, we need to credit that liability. And when loss is increasing, we need to debit the revaluation account. So the journal entry is revaluation account debtor rupees 4,000 to outstanding salary rupees 4,000. The last term, an unrecorded investments worth rupees 6,000. An asset, an investment is not recorded in the books, so we need to record in the books of account. When asset is recording, the asset will increase. When asset is increasing, we have get profit. When profit is increasing, we need to credit the revaluation account, and when asset is increasing, we need to debit the asset account. So the journal entry is investment account debtor rupees 6,000 to revaluation account rupees 6,000. Here we recorded all the transactions related with the revaluation into the journal. Now what we need to do? We need to ascertain the profit or loss of the revaluation. For that purpose, we need to make a revaluation account. Then we can calculate the profit or loss, the net profit or net loss of revaluation. This is the format of revaluation account. All profit will record in the credit side and all loss will record in the debit side. That means when asset increases, liability decreases, and unrecorded asset, these are all recorded in the credit side, and when asset decreases, when liability increases, and unrecorded liability, these are recorded in the debit side. Okay. Now we can go through the journal entries and record the transaction into the revaluation account. The first transaction is revaluation account debtor to machinery account. Machinery values decreasing, so we can debit the machinery into revaluation account to machinery 10,000. Second one, building account debtor to revaluation account. Building amount is increasing, that means the profit, so we can record the credit side by building 20,000. Then revaluation account debtor to furniture account. Furniture values decreasing, so we can record the debit side to furniture 2,000 because it's a loss. Next, stock account debtor to revaluation account. Stock values increasing, that means profit, so recording the credit side by stock 3,000. Then revaluation account debtor to provision for doubtful debts. Provision for doubtful debts is a liability, so we have get the loss, so we can enter the debit side to provision for doubtful debts 500. Next, creditors account debtor to revaluation account. Creditor is decreasing or creditor is write-off, so we can get the profit. Then recording the credit side by creditors 1,500. Next, unrecorded liability. When liability is increasing, we have the loss, so we can record debit side to outstanding salary 4,000. And the last one, the unrecorded asset. When asset is increasing, we can get the profit, so we can record in the credit side by investment 6,000. Now we can total both sides. Here the credit side is more amount, that means profit side is more. The total amount credit side is 30,500, so we can write here 30,500 in both sides, and the difference 14,000 is the net profit, and this net profit is transferred to old partners only, not the new partner. So this net profit transferred to old partners in the old ratio. Okay, this 14,000 we can distribute to the old partners, so we can write here to net profit transferred to X capital account 8,400 to Y's capital account 5,600. Now we need to make the journal entry for this net profit. The journal entry is revaluation account debtor to X capital account rupees 8,400 to Y's capital account 5,600.